Our next guest is David Reeves of Calidus Resources. David is a mining engineer with over 30 years mining experience in Australia, Africa and Europe, and has been instrumental in the progression of 4 mining projects through feasibility to project development. He holds a first-class WA mine manager's ticket and a graduate diploma in finance and investment, and has extensive experience in international capital markets through his involvement in various listed London and Australian companies. Please welcome David.
Good morning, ladies and gentlemen. Thank you very much for attending or viewing online. I'm here to talk to you about Calidus, which is developing the Warrawoona Gold Project just outside of Marble Bar. Marble Bar claims to be the hottest town in Australia, and I'd argue that the Pilbara, where Marble Bar is located, is actually one of the hottest spots for gold in Australia as we stand today. Now, is this fake news? Is this going to be taken down from Facebook? I don't think so. 2 gold mines being built in WA at the moment, the Pilbara. Glenn Jardine from De Grey will be talking about the amazing exploration success they're having in the Pilbara. And we feel very fortunate to be part of the Pilbara gold story, a dominant land position in the East Pilbara of Western Australia. And I'd like to tell you more about what we're up to there. So what are we up to? We are building. We're one of those 2 under construction. Yes, we have just started. It is early works. This is access roads. We're putting in a 240-man village. We're putting in the water for that, the telecommunications. So all that base infrastructure is coming together this year before Christmas. And then next year we'll kick off with the main plant construction, tails dam, into the mining with the aim of producing gold thereafter. So it is a very exciting time. There is a lot happening at site, and it's always a pleasure to get up and see the changes each and every time. Now, this is a bit of a risque move that I'm about to do, which is putting up a slide from last year, what we said we'd do. But we do pride ourselves on achieving what we say we will do. And this was a timeline from 15 months ago, and I'd just like you to focus on the bottom 3 slides here, which is, well, the environmental permit. We have EPA and ministerial statement sign-off, so we have completed that. The DFS we did put out in Q3, and we have commenced that early works construction ahead of schedule in Q3. So we are very proud of that. We look forward to continuing to achieve those milestones, and one of the key reasons we do achieve that is for the people that we have managed to attract so far and continue to attract. It's a bit of an older board and management team, but I'd argue it's a very experienced board and management team. Mark Connolly is very well known. Between myself, Don Russell and Paul Brennan, we're all mining engineers. We've all been GMs. We've developed mines before, and to have that history and experience in our company, I think is one of the main reasons we continue to tick those boxes. Enterprise value sitting around the 140 million as we speak today, and I'd like you to remember that number for later in this presentation. Major shareholder, Alkane Resources, has been a fantastic shareholder and chipped in along the way to help us get to this point. Board and management have a lot of skin in the game, which is very important as well. And we've got good analyst coverage going on, and I do apologise to the Euros Hartley's team. I couldn't find a new logo to download. You're all wearing your caps and your shirts, but unfortunately it's not there, but some really good analyst coverage as well. So zooming in at the Pilbara, this is an area blessed with infrastructure, mainly due to the iron ore that's in the region. So as I said, we're putting in comms. That's Telstra firing back to Marble Bar. We're going to upgrade the Marble Bar Airport. The Shire of East Pilbara, very supportive. They're putting in $5 million of the $7 million to upgrade that so we can land jets into Marble Bar. All-weather bitumen sealed road from Port Hedland in, so very easy to get goods in and out. And probably most importantly, the LNG supply coming from the Northwest Shelf. Potentially, well, we are going to truck that in, and that gives us very low power costs. So infrastructure rich, keeps your capital costs down, and certainly helps the economics of the project. Resource at the moment, 1.5 million ounces. It's open in all directions. Couple of the key points here, measured resource 12.5 by 12.5 metre drilling. So it is a pin cushion. We do understand the geology. This is our key risk for any startup is grade, and we feel we've gone about de-risking that as much as humanly possible with that drill spacing. The remainder in the pit is between 20 or 25 by 25, so we really do have a good feel for that geology, which we've then diluted with big blocks for mining to get the grade that we're going to be feeding through the plant. On this slide, you'll see a red box. That is where we're drilling currently. We've only got the resource down to 250 metres below surface. It is open. We look forward to releasing those results before the year's out because we believe that this mine will be around for many years to come, and the underground is a key component of that. If we look at ore reserves, so we've got over 500,000 ounces in reserve at the moment. This is a cross-section through the pit. It is a wide ore body. We are looking at bulking it out. But I think one of the interesting points on this slide is if you look at the top where all the purple magenta is, that's where we've done our 12.5 by 12.5 drilling, and you'll see we're getting higher grades up there as we constrain the modelling technique. And I think we'll see more of that as we get into operations, which only provides upside. Strip ratio 3.6 to 1. Our major problem at the start is finding enough waste to build ROM pads and tails dams. So a very nice problem to have. But it does mean we've got great flexibility scheduling-wise when we are into startup and into operations. We will stockpile a lower grade ore that will enable us to feed about 1.2 grams through the plant for the first 6 years, and that stockpile will then provide base load as the underground ramps up. Processing, we're putting a 2.4 million tonne per annum or 2 million tonne in fresh plant in. GR Engineering are the preferred contractors. We hope to finalise that in the next week or so we can get the mill ordered and underway. Very simple circuit. It is about as good as it gets. It's a single stage crush, sag, gravity, CIL, out come your gold bars. It's soft rock, it's a coarse grind, combined with that lower power cost due to the LNG, gives us a very low operating cost, and that helps our all-in sustaining cost, obviously. To the side of this, and quite importantly for later on in the presentation, we do have a little float plant. There are some smaller, high-grade refractory ore bodies around the area. We did decide to put a capital in for a float plant to treat just a small little deposit called Copenhagen, runs 6 grams at surface. We produce a concentrate, sell it. It is a totally parallel circuit, but it does give us optionality to go and look at higher grade deposits that might be less metallurgically delectable as what we currently have at Klondike. So what does this all mean? We need $120 million from January 1 to build this. It's an 8-year mine life over the first 7 years, averaging 90,000 ounces per annum, under 1,300 all-in sustaining cost, and with the gold price over double that at the moment. Obviously a very, very healthy margin in that regards. If we look at the ounce production profile, we're building steadily through to year 6. That's when the underground starts to tail off under the current scenario, but as I said, we're doing that deeper drilling. We do expect to find a lot more ore at depth, and we'd expect to see that production continue well into the future. You can read all the various metrics on the slides here. EBITDA at 2,500, we're sitting around that 110 million per annum. Current gold price, that's sort of 125 million per annum. And if we go back to our EV of just over 140 million in our capital structure slide, that's where I see the compelling value ahead of us as we move into production over the next 15 months. One of the things that was a pleasant surprise, and I don't often watch the budget, I must admit, I have other things to do in life normally, but the budget was quite interesting about tax write-offs and the capital and how that might be written off straight away instead of depreciated over time. Why is that such an exciting statistic? Well, it's all to do with cash flow up front. We are looking at borrowing debt to finance this. The more cash you have up front, the lower the risk, the more happy you are to take on potentially larger debt than you'd normally look at. So with this immediate write-down, we think that will free up more cash flow in the first couple of years than we've modelled, and that's obviously affecting our thought process on debt financing. So if we have a look at where we're heading forward, we've been through the EPA, we're now into the operating permits. They'll come out either late this year or early next year. We've finished the feasibility. That's allowed us to get into this financing. We have put down that we will announce the financing this quarter, so look out for that. And we'll be trying to bring into account some of those little wins like the budget and the capital write-downs. Development-wise, proof's in the pudding, the photos are there. We are under construction. We will look at commencing main project kickoff in Q1 next year, and gold realistically will be 12 months after, so realistically Q1 2022. So that's where we see the base value coming from in Calidus in the next 15 months. But at the same time, we do have a twin stream approach to value. Obviously, the drill bit is being very well rewarded these days with exploration success. And we've certainly got a large ground holding that we need to do justice to. So we've got various areas we're looking at. We've got right next to Klondike, we've got our Warrawoona Regional, so contiguous to that. We've got Otways, which we've been drilling, which is a recent pickup. Bluespec, which I'll talk a little bit more about, but a lot of targets to generate. Near mine, multiple shears. We've really only targeted the Klondike shear and the St George shear. We've been waiting to get our detailed aeromag and radiometrics, which we put out this morning. We've had some consultants doing some priority targeting, and I suppose it was a bit of a surprise what they've come up with. We've been looking immediately west of Klondike, but there appears to be a very large structure, the Brockman Hay structure, heading out to the west of Klondike that's never seen a drill hole and contains a lot of the priority 1 targets, which is to do with magnetics and fluid flow, and where the geologists believe are the most fertile areas that we should be looking. So the geologists will be onto that in the next 6 months, out in the field, truth testing that, and we aim to do some drilling in those targets next year. Bluespec is an acquisition we announced recently. We're still to close it, but we're very excited about it. Why are we acquiring deposits this close to production? We just saw this as a natural bolt-on and a huge value add for the company. This has to be one of Australia's highest grade resources, 216,000 ounces at 16 grams. Every decent mining engineer with his salt just wants to get hold of something like this. What it does to us, and we hope to put out an integration study in the next quarter, will be to fill that float plant I talked about previously. And that's one of the reasons we put it in. This is not displacing ore from Klondike, this is just adding to our ounce production. So we see ounce production up, EBITDA up. That obviously flows through to valuation, and that's why we're so excited about Bluespec, and we look forward to informing the market further on that over the next 6 months as we progress it. We don't look at ourselves as undervalued. We just say there's a hell of a lot of value to be had as we move through that, the process over the next 12 months and we head into production. On any metric, EV an ounce, EV, EBITDA, we see a lot of upside. I purchased again last week because I think it's one of the safest bets going around that I know of. And over the next 12 months, as we de-risk the project and advance it, we'd expect that to re-rate over time as we tick off those boxes that we still have outstanding. So in summary, we've got a team that's done it before, fantastic to work with. We've got a base production of 90,000 ounces with a very substantial margin, 8 years mine life. We have a resource open at depth that will continue to support that mine life over time. With that central mill in the East Pilbara, we've got a huge opportunity like Bluespec to add on resources, build that production profile, build that cash flow and build that value for shareholders, while at the same time really starting to commence exploration on our tenements in the East Pilbara, where we see certainly a large amount of upside coming from them over time. Thank you very much.
Thank you, David.